All countries are in debt. So, who is the creditor? 99% of the world's 195 countries are in debt. The United States currently owes more than $38 trillion, the highest figure in its history. With roughly $14 trillion in debt, the European Union ranks second. Japan's debt has reached nearly $9 trillion. Even powerful nations such as export champion China, oil-rich Saudi Arabia, and industrial giant Germany carry massive debt burdens. It sounds contradictory, doesn't it? If everyone is in debt, who is the creditor? Nothing is quite as it seems. Do not think of debt as a heavy burden. It is one of the load-bearing pillars of modern life. Every war, every crisis, every rise and collapse activates the debt mechanism. If you follow the chain of creditors all the way to the end, you encounter an unsettling truth. The creditor network resembles a connected nervous system. The world is not indebted to one specific entity. It is indebted to itself. But do not assume this arrangement is equal or fair. Total global debt exceeds $315 trillion, nearly 3 times the size of the global economy. We are navigating through a vast ocean of debt surrounded by enormous waves. How did we get here? Long before modern banking, the concept of national debt was born out of war. In 1694, while fighting France, England exhausted its gold reserves. The king turned to merchants who agreed to finance the crown in exchange for permanent interest payments guaranteed by future tax revenues. Thus, the Bank of England was established. The state gained the power to spend money it did not yet possess. For lenders, a remarkable product was born: the government's promise, a promise that could be bought, sold, and transferred. Government bonds were created, laying the foundation of the modern financial ecosystem. France and the Netherlands adopted and refined the system. Debt ceased to represent weakness and instead became a symbol of strength and credibility. The newly independent United States used this financial model to expand westward. National debt was no longer a sign of decline, but a tool of development. What is the world's largest export today? Debt. Today, total global government debt stands at around $110 trillion. Approximately 60% of it belongs to the US, China, and Japan. A significant portion of US debt is held domestically. The foreign share is comparatively limited. So when people claim that America is dependent on China, that does not fully reflect reality. In many ways, America owes itself. The system operates in a closed loop. The Treasury issues bonds, funds purchase them. The central bank provides liquidity, citizens pay taxes, and interest payments flow back into the system. This model is not unique to the United States. Japan lends to the US. The US channels funds to Europe through the IMF. Europe finances developing nations through the World Bank. Developing countries invest their reserves in Western bonds. This structure resembles a hall of mirrors. Each country appears to be a creditor while simultaneously being a debtor. Reflections create more reflections. The lines blur. The rule is simple. The game does not end and players cannot leave. Behind government bonds stands a vast institutional network: hedge funds, pension funds, sovereign wealth funds, and central banks. They are the true price setters of the system. Interest rates function like a moral grade for economies. Who will borrow cheaply and who will pay dearly to survive? The decision is made at that table. Central banks do not merely manage debt. They create it by generating new money in exchange for bond purchases. One person's burden is another's security. The economy is the story of weights shifting from one place to another. Every banknote in circulation corresponds to a debt somewhere. Without debt, there would be no money. Every coin, every banknote, every digital dollar carries a promise of future payment brought into the present. The system functions like a clock, as long as trust remains intact. But what happens when trust erodes? In 2010, Greece effectively collapsed under its debt burden. Interest rates skyrocketed. The European Central Bank and the IMF intervened with rescue packages that included tax hikes, spending cuts, and mass unemployment. In Argentina, repeated defaults turned debt into a structural fragility embedded in national memory. In Sri Lanka, depleted foreign reserves led to fuel shortages and political upheaval. When the system collapses, creditors step into the spotlight. The IMF, rating agencies, bondholders. Debt is not designed to be fully repaid. It is designed to be rolled over. Governments issue new bonds to pay old ones, a process known as refinancing. The price of stability is interest. The global economy depends on paying that price. If major nations were to eliminate their debt entirely, the world's most trusted financial instrument would disappear. The dollar supply would contract. Deflation would follow. Debt will always exist. It increases to keep the wheels turning. Governments pay interest through tax revenues. Taxes are largely paid by workers and producers. Interest income, however, flows primarily to large financial institutions and investors. Thus, debt represents not only a transfer between countries, but also between social classes. Debt and inequality rise together. Creditors are not villains. Debtors are not innocent victims. Both are parts of the same system. But what happens if the system stops? If new debt can no longer sustain old promises? Then the question, who is the creditor, becomes personal. There is no single face at the top, not one country, not one city, not one institution. The system is a whole, and we are inside it. Modern finance transformed debt into money. Governments issue it, banks multiply it, investors trade it, and citizens depend on it. If the balance breaks and trust collapses, the curtain falls, revealing that debt is a promise that cannot be sustained forever. We hope the Inside Finance History team has delivered both engaging and thought-provoking insights. Please subscribe to stay informed about our future content.